Hey everyone, welcome back to the channel. I'm your host Ian, and today we're diving into how Canada really dodged a major bullet during the 2008 global financial crisis. While the US was suffering from a massive housing meltdown, bank failures, and deep recession, Canada experienced a much milder hit. House prices dropped just 9.5% and sales fell about 40%, but the recovery was really swift. Let's start with the big picture. The 2008 crisis kicked off in the US with a housing bubble fueled by loose lending, subprime mortgages, and heavy securitization, where banks bundled loans and sold them off, offloading the risk to other investors. When the borrowers started defaulting en masse, it triggered a chain reaction. Banks collapsed, credit froze, and the economy just tanked. Home prices in the US plunged over 30% from peak to trough. Foreclosures skyrocketed and it took years to recover. In Canada, things played out a bit differently. Our banking system held up without a single failure or bailout for insolvent institutions, though there were some liquidity supports. The recession here was shorter and shallower than our own downturns in the early 80s and 90s. So why was that? It boils down to a more conservative, regulated approach. Canada has a concentrated banking sector with just a handful of big players that control over 90% of the market. They're overseen by one federal regulator, the Office of the Superintendent of Financial Institutions, which keeps a tight watch on everything from capital requirements to off-balance sheet risk. Unlike the US, with its thousands of banks and patchwork of state and federal rules, Canada's system allows for nationwide branching, which spreads risk and promotes stability. A key factor was our lending practices. Canadian banks couldn't afford the kind of no down payment or teaser rate subprime loans that existed south of the border. Here, if you put down less than 20%, you need mortgage insurance through the Canadian Mortgage and Housing Corporation, CMHC. And to qualify, your total debt service can't exceed 40% of your gross income. Subprime mortgages made up less than 3% of the market in Canada, compared to 15% in the US. Plus, banks here mostly hold mortgages on their books instead of securitizing and selling them off. Fewer than a third were securitized pre-crisis versus nearly 2/3 in the US. This originate to hold model meant banks had skin in the game, encouraging them to lend carefully. Pre-crisis, from 2000 to 2007, Canadian house prices had been climbing steadily, up about 80% nationally by late 2008. But when the crisis hit, the market began to cool. The resale home prices peaked in mid-2008 and fell by around 9.5% to their trough in early 2009. New home prices dropped even less, about 3.5%. Sales took a bigger hit, dropping roughly 40% from their 2007 highs as buyers pulled back amid economic uncertainty and tighter credit. National MLS sales went from over 520,000 in 2007 to around 434,000 in 2008, with even sharper monthly declines during the worst of it. Delinquency rates rose but stayed low, under 1% overall, thanks to those strict rules. The recovery here was remarkably quick. By mid-2009, prices already started to rebound, and by 2010, they had surpassed pre-crisis levels in many areas. Housing starts, which fell from 211,000 in 2008 to 142,000 in 2009, bounced back to over 189,000 by 2010. The economy as a whole contracted by 2.9% in 2009, but grew 3.1% in 2010. Low interest rates from the Bank of Canada also helped stimulate demand, and pent-up buying kicked in once confidence returned. Exports and commodity prices also aided in the rebound, given, of course, Canada's resource-based economy. Before the crisis, from, say, 2002 to 2007, real estate was widely viewed as a solid, appreciating investment. Prices had been rising steadily for years, driven by low rates, population growth, and economic stability. Many Canadians saw homeownership as a path to wealth, kind of like a forced savings plan that always went up. Polls and reports from that era show high confidence. For instance, in 2007, surveys by a group like Ipsos Reid indicated over 70% of Canadians believed property values would just keep increasing. There were some whispers of overvaluation, but overall, the sentiment was optimistic. People weren't broadly fearing a bubble. It felt like the market was on a sustainable upswing, especially compared to the US, where warning signs were already flashing everywhere. During the crisis, though, from late 2008 into 2009, sentiment did shift to caution and some fear. As global headlines screamed about the US foreclosures and bank collapses, Canadians worried if we'd get hit hard too because we were so close to them. Expert opinions were mixed. The Bank of Canada urged vigilance but said it really wasn't a bubble yet, pointing to fundamentals like low inventories and demographic demand. The economists called it overvalued by 15 to 35%. TD Economics estimated national overvaluation at 12%, predicting it could hit 13 to 15% by the mid 2010s. Overall, while there was bubble talk, most analysts said Canada's market wasn't as frothy or as exciting as the US, and the mild drops reinforced that. It wasn't panic, but people were definitely a bit worried at the time, seeing real estate as a riskier asset to hold than they previously thought it was. Post-crisis from 2010 onward, relief set in as the quick recovery boosted confidence again. Prices kept climbing, up another 50% or more in the decade after, and real estate regained its status as the go-to investment. The lessons lingered. Surveys in 2010, like those from RBC, showed rising awareness of the debt risk, with mortgage arrears ticking up slightly to 0.44% amid unemployment. Experts emphasized affordability strains, and there was more talk of monitoring bubbles and just trying to keep an eye on that one. People started viewing real estate as resilient but not invincible. Still a strong asset, but with the understanding that regulations had saved us that time. A 2010 CREA report noted that gains were temporary and supply increases would cool things down, tempering the forever appreciation mindset. So, what lessons in resilience can we really draw from this? First, strong regulations, they do work. Canada's single regulator and strict lending prevented issues that ended up dooming the US. Second, keeping risks on bank balance sheets aligned incentives for careful underwriting. Third, mortgage insurance through the CMHC acted as a buffer, ensuring defaults didn't spiral out of control. And finally, a diversified national banking system absorbs shocks better than the fragmented one, giving Canada to recover as a whole when certain parts are struggling more than others. These factors not only helped us weather the 2008 storm, but offered insights for today as we navigate high debt levels and rate changes. Resilience comes from prudence, not speculation. That's all I got for today. Thanks for joining me, and I'll see you on the next one.